talked about the yield to maturity on and on many times, and we know so far that yield to maturity is the return generated by the bond. It is also the return required by the investors. And here I decompose the return of the bond into 5 components. And you can see that the first two together would give you the nominal rate. One of the two is the real rate and another is the inflation. And I think you have learned that from your macroeconomics class. And there are some other risk premiums. First and foremost, we should know that in the financial market, higher risk is associated with a higher return. And if the bond is more risky, meaning have a higher possibility of default, or the company is more likely to get bankrupt, then if for an investor to buy the bond, then the investor would require the company to pay higher return. Otherwise, the investor would not buy the bond. If you look at these two rates, the real rate and the inflation, when we add together, it is the nominal risk-free rate. And what is a nominal risk-free rate? It is the rate generated by the treasury bills issued by the Department of Treasury of the US government. And this security has never ever defaulted in the past. If you look at the bond issued by Russian government, then it has a default history. It was called the Russian debt crisis. Basically, the Russians just say we are not paying back our bond, we're not responsible for that, and that created a global financial crisis. And also the bond issued by Syria or Iraqi governments, their bond also default, meaning the borrower, their government will never pay back the debt due to the political instability. But for US, the US government never default on the payment of their debt. So that means the T-bills are the safest assets in the entire world. Every other financial asset should be built on these risk-free assets, meaning that all the other assets should at least provide the nominal risk-free rate. Right now, the nominal risk-free rate is around 2%. So if any other borrower wants to attract investors, they have to give higher than 2% interest. Otherwise, investors would just put the money in the treasury bill as a safe haven. Take me for example. If I want to open a Panda Express and I want to borrow money from you, I want to borrow $20,000 from you to open my restaurant, then would you be willing to lend the money to me if I pay you 2% per year? Of course not, because you are better off to put your money with the US government to invest in the treasury bills instead of investing in me. Because if you invest in me, there is a much higher risk than the US government. I could just take your money instead of investing in the restaurant. I just run away with your money to China and you can never find me. As you can see, the same idea applies in the financial world. Any other entities, including corporations, municipal government, they all have a certain possibility of a financial downfall, a possibility of not being able to pay back their debt. So in order for them to sell their securities, to sell their bonds, they need to offer higher rate. Otherwise, investors would not invest in them. And here is the general theme in the entire financial world: higher risk, higher return. And every financial asset should give a return higher than the risk-free rate. And if the risk goes higher, then the return should be higher. And we can also divide the return into two parts. One is the risk-free part, and another part is called a risk premium. And the risk premium is partial return to adjust the risk level. And of course, the risk-free return could be divided into real return and inflation. So in the financial market, as I mentioned, it's either higher risk and higher return situation or lower risk, lower return situation. And there does not exist a high risk, low return. So this is a terrible, terrible financial investment: high risk, low return. And eventually, will everybody find the essence of it? nobody will buy it and it will disappear in the long run. So that combination of a high risk, low return does not exist. And another combination, low risk, high return. This sounds very terrific. However, it will not last long either, because when everybody sees this opportunity, they would swarm to buy it, and it will drive the price up, and there will be less and less room to make profit, to make a positive return. So the return will fall in the following period, and eventually you would have a low risk and a low return. So that's how the financial market adjusts itself. All right. And you should also know that risk is estimated first, and it should be known to investors. There's no fraud. There's no information asymmetry. In the real world, a lot of financial scams exist, like a Bernie Madoff. He ran a Ponzi scheme promising investors with almost 0% risk, but 10% annual return, which is considerably high. That was an exception in this theory. And if we take a closer look at the structure of the return of the bond, or the formal name is yield to maturity, as I have covered the first two, all the others are called premiums, because if this risk level gets higher, then the return would get higher. One type of risk is called a maturity. So if the bond lasts longer, then there could be more uncertainty involved. Then the investors want to be compensated higher. All right. Take the treasury bill, for example. Even for the safest assets, the longer treasury securities is called a treasury bond, which lasts for 30 years. It should give a higher return than short-term treasury security, which is treasury bill that lasts for 3 months, because as the time goes by, there could be a lot of possibilities of bad things happening to the company, and the company could get a default, and that evokes risk. And the second one is default risk. So the default risk is basically the company gets bankrupt. The company is unable to pay back its debt, and that falls into the definition of a bankruptcy. And the last one here is called a liquidity premium. It is also a risk. Liquidity is a good thing. Liquidity essentially means the security is easy to transact, it's easy to sell, it's easy to buy. If it is illiquid, that means it is hard to buy or sell the bond. The investors should get compensated for the difficulty of buying or selling this bond. So the bond should offer a higher return to compensate the investors for the hardship of transacting the bond, and this is called a liquidity premium. And for the nominal risk-free rate, we have a treasury securities. If it is short-term, we call it T-bills. If it's long-term, we call it T-bond. And how do we distinguish short-term and long-term? The cutoff is 1 year. And here for the yield, as you can see that for the long-term bonds, the yield for T-bond is 2.11%, and that basically is the safest. And for all the other bonds with the same length of maturity, I mean, they are all 10-year bond, we also have a different rankings for them. We have a AAA bonds. Those bonds are issued by companies with the safest assets. Still, they need to offer higher yield than the T-bonds, just because they are companies, they are not as safe as U.S. government, so they have to give investors higher return. And the lower rank would be AA. Their risk level gets higher, so the yield would be higher because investors require more return. And then you have a single A, triple B, double B, single B, triple C, so on and so forth. If a bond falls into the category of a D or double D, then we call that bond a junk bond. And junk bond can give a yield of 20% or higher, but it definitely has too much risk of a default, meaning the company is really junk, does not have a healthy financial situation to give investors the money back. But for speculation purpose, you may buy and sell them in a short-term period. So what are the factors that affect the default risk and the bond ratings? We know that default risk affects bond ratings. If it's a higher risk, then the bond should be rated lower. So here are the ratios we learned in chapter 3, all the financial ratios like the debt ratios, coverage ratios, profitability ratios, and so on. And we know that if the current ratio gets higher or profitability ratio gets higher, then that's better for the company. That's a better quality of a bond. And also you know that if the debt ratio is too high, then that's bad for the company, then the bond should not be ranked high. So if you look at the different grades of a bond, you see for AAA, the return on capital is the highest, and also the debt to capital is the lowest. For the lower grades of the bond, the return on the profitability side is pretty low, and the debt level to capital is pretty high. So that means a high financial distress and a lower level of earnings. So who are the companies that rank all the bonds? Fitch, Standard & Poor, Moody's, and they do all these rankings. These are the most popular companies on Wall Street to do the job. And here are some other factors that affect the bond ratings. As I mentioned at the very beginning of the chapter, bond is a contract, and different kind of a contract would have different covenants. That's the agreement between a borrower and the lender. Either you have a secured debt or unsecured debt. The secured debt meaning the debt has collaterals. If the company default, then the lender would have a claim on the company's assets, just like the bank take away your house if you fail to pay your mortgage. And there's also seniority. So for certain lenders, they can have a better claim of the company's cash flows. And there's also guarantee provisions, sinking fund provisions, and also debt maturities definitely is a part of bond ratings. Some other factors would be earnings stability, not just the level of earnings, but also the stability of the earnings. We don't want the earnings to be volatile. And also regulatory environment would fit in the international investment market. And also for certain industries, even though in the same country, in the United States, they are facing different types of regulations. Like the financial industry and the utility industry in the United States are facing more restrictions than any other industries. And the other factors here could be liabilities level, it's just like the debt level, or accounting policies. Just to summarize, if the bond is riskier, the investors would require higher return. And in this bond chapter, we call that yield to maturity. Since the bond future cash flows are fixed, a higher required return leads to a lower current price. What does that mean? If the risk is higher, then investors would require higher return. And when investors require higher return for the same cash flows, they would discount more. So you could have a less present value of the bond or less price for the bond. So that means bonds with higher risk are cheaper. The bonds with higher risk are cheaper. Some findings suggest that riskier stock grow more in price. It does not violate the rule of a high risk, high return. It's just for stocks, we don't know the cash flows in the future. So it's unlike a bond when we know the future cash flows. Just a side note, if a bond default, then that means the company would be in the status of a bankruptcy. They could either, according to corporate law, file Chapter 11, reorganization, or Chapter 7, liquidation. Typically, companies want Chapter 11 because the company can still survive in this situation. Just like General Motors, they filed Chapter 11 during the 2008 financial crisis, so they can still keep running and producing cars as it is today. The creditors or the lenders of the company, they prefer Chapter 7. Chapter 7 is a bankruptcy, that is a debt for the company. If that is the situation, then the company would be forced to sell all its assets. This process is called liquidation. When all the assets are sold, the cash would go to creditors first, and that's what creditors really want.